For today, I'm glad that you all have chosen to join up with us. We've got something that's a very important topic for today, and that is partnerships, right? So you got syndications, you got partnerships, and it's not about how much money that you make, it's actually about how much you keep. And part of what you make and what you keep and how you structure your deal boils down to your partnership structure. And so today we're going to be talking about different partnership structures, and I'm excited to have that conversation. Now, Lupe, I'm trying to get you in here. I don't know what's happened with that, but anyways, so I'm excited to have that conversation. Let's go ahead and do a brief introduction. So I'm working on one monitor, so bear with me with this. Can y'all see my screen? Get a head nod for those who got the cameras on. Thumbs up there. Okay, we're good. So my name is Jason Stubblefield. I've been investing in apartment complexes since 2016. The website that you're looking at right now is SNS Capital Partners. That's like Sam, Nancy, samcapitalpartners.com. And if you go to that website, you just want to know a little bit about me, a little bit about our company, what we do, investments that we made, etc. That's a place to do it. Also, we have investment opportunities. So if you want to hear about our investment opportunities, maybe you want to see what one of our deals looks like, if you go over to the Invest tab and you have that Join Now button. So that'll bring you with a brief form. You fill out that form, you'll be put into our world, right? You're in the sphere of SNS Capital Partners, and we'll reach out to you and see if we have any deals that might work for you or fit your criteria. All right, so I'll stop that share, and let's get back to the show. So, yeah, we're right at 5 afterwards. So, Tiffany Spann is going to be a guest speaker today. So you get a break from hearing Jason go on rants and gems and jewels, whatever I'm doing here when I'm talking weekly at Tuesday. But we've got a guest speaker today, and Tiffany's going to share a little bit about her story. So I met Tiffany, I don't know, what was it, maybe a couple of months, 3 months ago. We got connected, was very impressed with what she's doing. She's also located in the Northern Virginia area. I know that we have some of our attendees that come from Northern Virginia. Well, I say Northern Virginia, but actually she's in Maryland, but the DMV area. She's worked with up there, and I'm really impressed with her background and excited to hear what she's got to share with us today. So Tiffany, if you're ready to rock and roll, I'm gonna go ahead and turn it over to you.
Definitely, I'm ready to rock and roll. I'm actually gonna share out my screen here.
Yep, I just made you co-host. And as we get started here, if you have questions about what Tiffany is saying, I definitely like for these to be interactive. So if you're in Facebook, or if you're here with us on Zoom, feel free to just put it in the chat, and I'll make sure that we get it addressed with Tiffany.
All right. Are you able to see my screen?
I am. Yep.
Okay, awesome. Before I dive into the presentation, just to give you a little bit of my background, I actually started off in the single family space and smaller multifamily space. After a couple of years of doing that, I realized that it would take a whole lot of single families and smaller duplexes for me to hit financial freedom. So I slowly transitioned into multifamily, did a little short-term rentals, have a marina. And so today I'm actually going to go over a little bit of my story in this presentation, and also break down the differences between joint ventures and syndications. All right. So we're going to cover joint venture versus syndication, a joint venture case study that I have, as well as a syndications case study. Both of those are in progress, so you'll get to kind of see what's going on right now, how to optimize the two, and pretty much a summary of the pros and cons. And then we can dive into any questions that you may have. All right, so joint venture. A joint venture is an active partnership between two or more investors. The essential element of a joint venture is active participation in a property investment by each investor. An example would be if you're a great rehabber and another investor in the partnership is an expert property management manager, and then the third one is really good at the financials, then together you come together and everyone has a definite role to play. There's no role for passive investors in a joint venture. So everyone in a joint venture has say-so and is responsible for the day-to-day operations. In a syndication, the property investment in which the expected profits of the investment are issued is by a third party, and that's a syndicate investment. A real estate syndication includes sponsors, also known as general partners, or key sponsors included in that as well, and passive investors. Passive investors are also known as limited partners. The role of the passive investor in a syndication is investing the funds to help with the purchase of the property. The key principle is you're a loan guarantor, and the general partners, and as part of the general partner team, and they help to manage the day-to-day operations for the investment. They're also going to handle everything when it comes to the sale of the property, all the details surrounding that. A real estate syndication is actually viewed as a security. So every single syndication will have to be registered with the SEC. So now I want to dive into a joint venture on a commercial property that I am in on currently. This joint venture is actually a marina and a short-term rental located in Fox Lake, Illinois. So I just kind of want to walk you through what the returns look like versus the syndication that I'm also involved in as well. And so for this particular deal, there's 4 partners in this deal. At the purchase of this deal, there was a single family home on the property that had long-term tenants, and the tenants were paying $16.75 a month. We decided to convert the property to a short-term rental. So that way we would double the income from $20,000 a year to $40,000 a year. And here I have like what the summer rates and the winter rates look like. At the purchase of the marina, there was actually a master lease for a boat club there at $4,000 a month. But once we closed on this particular property, we began to execute our business plan, which included adding amenities to the boat slips, as well as leasing the slips individually and using the land during winter for boat storage. And so, as you can see here, I broke down the summer rates for the boat slips, the ones with amenities, and amenities include electricity and water to the boat slips, because when we purchased the marina, it was actually a dry dock, meaning no water or electricity was actually run to these slips here. And then here we have the winter storage rates. So you'll notice that the previous owner was more of like your passive quote unquote owner, whereas we kind of took this over to run it more or less like a business. All right, so this is the breakdown in numbers. Our purchase price was $945,000. For this particular property, we actually got owner financing with 10% down, and he financed the deal at 5.5% for 4 years. The closing fees were 3%. Acquisition fee was 6%. We did put an acquisition fee in for the partners that helped to find the deal, as well as bring the partners together and just help with funding. Our CapEx budget was around $57,000, and then we had $15,000 in reserves for a total of a little under $1.1 million. And here you'll notice the projected returns to the right. Our internal rate of return is around 27%. Our average rate of return is around 22%. And then I have here that our cash on cash is infinite after refi. And this is based upon an appraisal that was done back in 2017, where the marina had actually appraised for $1.25 million. And we're pretty confident that the appraisal will come in a little bit above that. So for that reason, we do have infinite returns after refi. And this here is a 10-year hold with an equity multiple of 3.2. And for this deal, we actually had to raise $250,000. Now, this deal isn't necessarily your average joint venture. This has definitely been like a rock star of a deal, but it'll pretty much provide you with an overview of the differences between the joint venture and the syndication. Now I'm going to jump into a syndication case study in progress. This one here was actually located in Houston, Texas, in 134 units. The pictures on the left were the pictures for when we purchased the property, and then the pictures on the right are as of today. So you can clearly see the difference in the modernization. And pretty much this one, we actually completely changed property classes here. So at the purchase of this property, the property was a Class B property, but it was located in an A neighborhood. So post-close, we actually began to execute our business plan of upgrading the property to a Class A and raising the average monthly rents to $375 a month per unit to align with the market rents. We were aware of the high economic vacancy prior to closing. However, post-close, there was more economic vacancy as there was an increase in evictions, tenant skips, and non-payments. Therefore, within the first 10 months, we actually had to turn 47% of the property, which in turn, of course, directly impacted cash flow. But on the upside, it's also allowing for us to execute the business plan a bit more quickly than we had anticipated. So here's the breakdown when it comes to the financing of this particular property. The purchase price here was $12 million and a quarter. Closing costs were $728,000. The acquisition fee was 3%, around $331,000. CapEx budget was a little over $4 million. The reserves were $134,000 for a total of a little under $18 million there. And here you'll see that our projected returns with the internal rate of return of 17.5. Our cash on cash is around 9%. And then the equity multiple on this 5-year hold, 3 to 5 year hold, is a 1.85 equity multiple. And as you can see, the total capital raise is a lot higher than the capital raise of the joint venture. But of course, the prices are a lot different as well. You'll notice that the returns are different. As I will kind of bring up a little bit later with syndications, because you do go through the SEC, there are more overhead costs when it comes to syndicating a property, whereas with joint ventures, you just have partners and you obviously you're going to pay for lawyer fees and whatnot, but the fees for the syndication are a whole lot higher.
Hey, Tiffany, I just wanted to bring out a couple of things that I think would be useful to the audience right now. So
Sure, you want me to back up a bit?
Yeah, well, yeah, let's go ahead and do it. So the first one, like with the marina that you all bought, right? When you did that one, that was not a short-term rental right away, right?
No, so it was not a short-term rental right away. Long-term tenants on both the marina as well as the house, long-term.
Gotcha. So you all were able to drastically increase the value by converting it from long-term rentals into short-term rentals. And that's one thing that I wanted to highlight for everyone on, because you're able to actually to realize those gains. Whereas like single family investors or people who are starting out, they may say, hey, I want to buy a single family and I'm going to run an Airbnb out of it, but you're still constrained to whatever market rate properties are selling for through the comparable approach. Whereas with this, you're doing a commercial loan, so you're actually able to realize that value that you got by converting it from long-term rentals to short-term rentals. Right? Is that what's happening?
Exactly.
Okay. Awesome.
Yeah. And one other thing that we're doing on this particular property that I don't have on here is there was a barn on the property that was pretty large. So we're actually going to turn that into like a meeting hall or venue that people can rent out. We're also going to add like the ice vending machine, a big ice vending machine out here as well. So, I mean, other streams of income to help push up our net operating income as well.
Got it. Okay.
Yeah.
And then with the syndication, one of the things I wanted to just highlight, right? So you turned over almost half of those units because you were increasing the rents by $375, right?
Right.
Okay. So yeah, just to know with that, I know that we've done rather aggressive rental increases too. And if you're doing something like that, what I see from some investors is that they will have a rent increase, like we're going to increase rents by $375 dollars per unit, but they will underwrite their expenses or sorry, their vacancy at like 5% throughout the whole time. Like if you're doing rental increases at that amount, you're going to have a lot of turnover as you do it. And so usually with that, what you'll do is budget in a little bit higher on the vacancy because you're just going to get more people who are not going to renew, which is going to be longer for you to turn. But once you finish it, obviously you're able to turn it around and just, as you mentioned, taking it from a B to an A.
Exactly. And one thing about this property is that at purchase, there were still a lot of COVID relief funds coming in. So once those funds started to dry up, that's when more evictions came into play and more tenants started skipping out and non-payments came into play. So, I mean, we had underwrote to a high vacancy, but not to the vacancy that we saw this quickly, but it's almost like a double-edged sword where, of course, it affects cash flow, but being able to execute that business plan faster means that, there's still that, the upside of things,
Mm-hmm.
Yeah. One other thing to highlight is that, with the joint venture, we'll be able to, start distributions a lot earlier than you will sometimes with the syndication, because you're kind of at the front lines when it comes to just the financials overall. And obviously, like the lifts are a lot different when it comes to, the two. So,
Mm-hmm.
All right. How to, I see a question or.
Yeah, two of them. I think they're relatively quick, and then I'll let you keep rolling because I know you got more slides.
Okay.
But what was the first one we have? So with those syndications, does every deal have to be registered with the SEC?
Yes, with the syndication, every deal has to be registered with the SEC.
Gotcha. And then we got another question. How did you find those two properties? Were these brokers, off markets? What were y'all doing?
Definitely. So both of the properties were actually off market. So I'll roll back to the marina. So on the marina deal, I actually have a partner located out in Illinois, and all of his marketing is targeted to direct to seller. So this was a direct to seller deal here. And then for the syndication, our broker actually knew a broker who was going to list the property, but before it hit the market, we were able to get this property.
Gotcha.
Mm-hmm.
Okay, cool.
All right. So how to optimize? I have, it depends. It's not exactly a straightforward answer, because your decision to enter into a joint venture or a syndication really does depend on your circumstances around your situation. In the end, it comes down to what best fits your goals. I have a lot of people ask me, Tiffany, what should I do? So it really does depend. And many times I say, if you're a really high income earner, it may make more sense for you to just invest passively in syndications, because if you continue to optimize your investment by reinvesting, you can actually, achieve similar returns as being an active investor. And here I just laid out what both of those investments look like if you had invested $100,000. But one thing that you will notice on both of the investments, the projections in year 3 is when both investments plan to refinance. And so essentially, if you were to add up all of your returns that you've received in years 1, 2, and then what you receive in year 3 from the refinance on both deals, you receive all of your initial investment back. So if you were to continue to just like reinvest in that, clearly you're going to, compound on your investments and really optimize that way. Another thing to think about is, as a joint venture, you are actively involved, and how many joint ventures can you actually, do at one time? So, you are going to hit a ceiling where, you may decide to, in year 3, if you're in on this joint venture, to move it over into a syndication so that you can invest more passively. Or when you get, more money up, you decide instead of 100,000, you invest 200 or 300 or more into syndications to, really cash flow more passively. But again, it does depend on your particular situation. But this is what the breakdown looks like between these two investments. And I will say that the marina deal is something that is, it's not, your average joint venture. It's definitely a really, really great deal. And it's something that the previous owner wasn't running as a business, but we're actually running it as a business. So that's one reason why we're able to kind of like optimize on those returns.
Mhm.
I'll just pause right there if there's any questions.
Yeah. So we got Ash, I got you in just a second. We had a question come in. It was just asking how can someone invest in a syndication?
Definitely. So in order to invest in a syndication, syndications are, you can either have like a 506B, which is for non-accredited investors, or a 506C. If you decide to invest in a 506B syndication, then you have to have a pre-existing relationship with the sponsor or general partners. And essentially, typically with syndications, there's some sort of minimum investment that the sponsor will require. Sometimes the minimum may be $50,000, sometimes $100,000, but essentially, if you find a deal that you like, then you'll be able to invest that way. But I would say, did that answer your question, or is there more to the question after that?
Yeah, I think that was it. Like mainly, so what Tiffany is saying is like you need to have a relationship with someone that's a sponsor. If you're not an accredited investor, if you are an accredited investor, then you still want to have a relationship with a sponsor. But the way that you do that can be maybe you see an ad somewhere, or if Tiffany had a deal that she's doing right now, you could just hop in, depending on how it's classified from the SEC, if it's a 506B or a 506C. So hopefully that clears it up. Ash, what did you have?
A couple of things. Thanks, Jason. Thanks, Stephanie, and everybody else. How do you find these to become like a sleeping partner, a passive investing partner? That's the first thing. How do you find these opportunities? And the second is, do you have, Tiffany, like a table like this, which would explain, like, in the same, I appreciate your highlighting the issue that, even as a passive investor, because of the compounding, you will do pretty well. And you can do only limited deals as an active investor, but as a passive, you can do much more. So do you have like some kind of a table showing the returns on even on passive versus being an active partner with GP?
I do in the underwriting, so you can see. So, as a general partner, you do get an acquisition fee, which the acquisition fee, I had another slide there, but you do get an acquisition fee. You may get part of the asset management fee, and then you get profit from the sale as well. So, and another thing about the general partner, there is multiple partners in the deal, because in order to actually manage a project like that, it's not going to be 2 or 3 partners or even 4 partners like there is on the marina, just because this is a massive project. So it takes all hands on deck, and you bring in, a really great management company to help you with that. But the underwriting actually goes into details on what the general partner would get versus the limited partner. But that's something that we could kind of if you want, look at offline in terms of the underwriting and how those numbers would kind of play out. And then your first question was how do you find deals like this? So essentially it's coming to meetups like this and getting to know other investors and kind of finding out what they do, because sometimes a lot of these deals can't be marketed. So if you don't know the person or know the general partner or sponsorship group, you won't be able to find these deals. One way that I actually got in on this particular deal, and on this deal, I'm a general partner, but even on my limited partner deals, where it was just finding a coaching program and then joining different meetups and masterminds. And that's how I pretty much networked with other investors to find deals. And that's how essentially both of these deals I was able to get into, because these partners I know from those, associations.
Well,
thank you.
All right, great. So Tiffany, I don't want to keep you too long. I'm glad that we have an active group, but just to be respect everybody's time, I'll let you finish up the presentations, then we'll come back to the questions at the end. So if you got questions, just put them in the chat and we'll do them after Tiffany wraps up.
Definitely. So this is pretty much a summary. I'm actually about to wrap up soon. I'll probably do more talking than what the slides have on here. So I wanted to outline some of the pros and cons when it came to a joint venture and a syndication. So for a joint venture, the pros include shared risk and shared cost amongst the partners. There's also less capital partners, investors, and a greater cash flow for active partners. I mean, it's not managing investors when it comes to joint ventures because you all are, invested together and share the same risk. Also in a joint venture, you're involved in all of the decision making. So everyone has a vote. Also with a joint venture, it allows you to grow your wealth and exercise your entrepreneurial skills. And some of the cons, there could possibly be an unequal contribution of money, time, and talent. So, I mean, it's really important to vet your partners and just really understand your roles and responsibilities. Again, joint ventures are more time consuming. So you are going to hit a ceiling on how many you can actually do. And then in a joint venture, each partner is financially liable. Whereas with the syndication, if you're a limited partner, you don't have any sort of like liabilities. Also, with a lot of syndications, depending upon the loan amount, there's a lot of non-recourse loans out there as well. So some of the pros of the syndication. So you have the ability to conserve funds for diversifying your property investment portfolio. You also collect what many of you know as mailbox money from cash flow. Many times you get distributions and you're not even really thinking about it. You know, they come quarterly, but I mean, it's something that you're really just letting your money work for you. Also, there's a lower risk for participation than other investment strategies. Some of the cons, they are more costly than JVs because you have to register with the SEC, and there is just overall, when it comes to a syndication, a lot of the due diligence and kind of like your cost associated with that upfront, but all of that is actually taken into account when you underwrite the deal. Also, passive investors don't have any control over the deal, so you are not involved in any of the decision making. I mean, you are just, collecting the check pretty much. Another con is that your investment money is tied up for the duration of the deal. So in the example that I gave, we do have a refi at the end of year 3. However, your money is tied up. It's not like something you can just cash out when you want to. But overall, those are the pros and cons of each. Oops. And now, any questions? Any other questions for you guys?
Got it. No, that was awesome, Tiffany. Let's see what we got in the chat when it comes to questions. So Jim asked, okay, we got some good questions here. So is it possible to do a TIC, which tenants in common, with investors on multifamily property, or is SEC exemptions the only way?
So let me actually read that question, because is it possible to do? I don't see that. I'm sorry. Oh, okay, here we go. Is it possible to do a TIC with investors on a multifamily property?
Yeah, so I think, Jim, were you talking about maybe if you're doing
1031 exchange?
You want to unmute yourself and ask that?
Yeah, I guess that's part of it afterwards. But I mean, I did where we were formulated an LLC, had a operating agreement with some kind of the general and limited partners inside the entity. This is smaller, 3 couples that were investing, limited partners. So I didn't know if there was a step in between where you didn't have to go through the full 506B or C SEC lawyer regulations if you're raising some money, if there's a, like that in between structure, and maybe that's a joint venture, except some of the people aren't going to want to be active in that as well. They just want to be passive. So it could be the answer is no. The other part is eventually, yeah, if you want to do a 1031 exchange, your limited partners they may not want to, but the the people running it may want to. That clarifies that.
Yeah, so that's pretty much a joint venture. And the people that don't want to have, a lot of the day-to-day responsibilities, then it's assigning them something because everyone should be active and there wouldn't be any sort of major decisions made without their buy-in and input as well.
So that could get complicated if you have a dozen people or something then too.
Exactly. That could be one of the cons to joint ventures.
Jeff, I don't know. I'm not a lawyer. I'm not giving you legal advice, as Jason always tells me to say first. But I just sold an apartment building and I wanted to do a 1031, but the other partners did not. And so it's kind of an all or nothing.
Right. Yeah. Yeah. I talked to some people and it was like do a drop and swap and restructure. And then, it was really messy.
Yeah. Drop and swap is, you can do that.
Yeah, while we're on that, so we're in the process of doing it. It's really one of those things that you have to set up your deal for in the very beginning. So if you want to potentially do a 1031 out of a syndication, it's complicated, but you sort of have to do that going in because your entity structure, and I don't want to derail the conversation going into this too much, but if you're doing this, I think it'd be valuable. So your entity structure has to be structured so that you have basically more entities. So everyone is investing in a entity. And this isn't going to make sense, but anyways, just try to follow me. So you're basically layering entities into your general partnership. So instead of it just GP LP, you're now going to have one main entity that everybody invests in, and then there's multiple partnerships underneath that so that it can be broken up. And this is a bad way of explaining it, but just understand that it can be done, but it's got to be done. The heavy lifting has got to be done on the front end so that you can break it up if individuals don't want to stay in all at the same time. It's basically you have to buy out their interest, and it's a whole legal circus. Also, so thanks for that question, Jeffrey. Appreciate that. Another question was, what was the amount you put in each unit to take it from B to A?
It was around 12,000.
Nice. Okay. Another question, when raising money, have you used private money lenders?
Not for larger deals. The numbers just haven't made sense. There was a deal a couple months ago. We had considered private money, but the numbers just really didn't pencil out.
Gotcha.
Do you use hard money as well, or just more of raising capital?
So when you say private money, I automatically thought about hard money. So
No, private money is separately. Private money is like individuals that you negotiate terms with. That hard money is those institutions that, they tell you how much you want to do and things like that. So if I'm talking about private money, I'm talking about, hey, I got a couple of doctors, they got money in their account. I can use that to put a deal together and give them equity that way. That's more private money compared to hard money. Is like, hey, this is what it is.
I got you. Yeah, I actually misread that question. I was thinking hard money. So private money is actually with the syndications. All of this is private money. Everyone's getting the same return. I'm not negotiating something with one person that I'm not with the other. So this is all, raised capital. So it is private money.
Okay.
All right. Next question. Ty, are there any restrictions or cons with partnering with a VC firm?
So a venture capital firm, are there any restrictions or cons? Ty, could you elaborate on that question a little bit for me, please?
Yes, and thank you for your time, Tiffany. So there are VC firms that are outside of being industry agnostic, and their goal is primarily to invest in real estate partners such as yourself. So, for instance, if you were to partner with a VC firm, hey, here's the amount of capital, give them 10-year projections. With you registering with the SEC or wanting to do a joint venture or syndication, would you find it, I guess, beneficial if you did partner with a VC firm? Because outside of you having to go find that doctor, go find that accredited investor, you can go straight to a VC firm and they can cut you a check for the amount of the property for a specific amount of returns that you all determine. Are there any cons to that?
No, but it almost sounds like sometimes if you have like a private office or another entity come in that wants to invest in the deal, they would just be another limited partner. Sometimes if they're bringing a significant amount of capital, they may want higher returns.
Okay.
So
Okay.
that way there could be like your class A, your class B investors, where class A is someone who's bringing in, $2.5 million. So the $2.5 million, VC firm or family office may say, hey, I need to get a little extra than someone bringing in $50,000.
Okay.
So
Okay.
yeah, that actually happens quite often.
Got you. Okay. So the good thing is there are no cons, but if the numbers make sense, it's okay to take that route.
Exactly.
Okay. Thank you.
Mm-hmm.
One thing I'll bring up as a potential con is that a lot of those companies will want control as well, depending on how much capital that they're bringing in. So you may want to consider that some of those companies may want to have control over major decisions. So if you want to do a refinance, they may want your approval before you do that. If you want to sell, they may want your approval in order to do that. So you're running the show, but they're going to have a lot of say-so in it. And it depends on that. So you can do it, obviously, but just be cautious about doing that. And then some of the ramifications, going forward, who's going to make the decisions, who's really got control of the deal, so that's something to think about. Additionally, the only thing I would say is just the structure of it. So sometimes those larger companies won't want other investors involved, or they may not want any smaller players, right? So they say, hey, if we're the capital stack, we want you to put in 10% of the deal or whatever, and then we're going to bring the rest, but we don't want any other limited partners or stuff like that. So that's something to consider. And then the last thing is just it's something that pardon me, I got my alarm going. So another thing to consider is if you have one person that's writing you a relatively large check, just be cautious, because if they decide to pull out for whatever reason, you want to have a backup plan or a contingency for it. So I just think that it's definitely a way to add fuel, and propel your career, but you just want to keep those things in mind, right?
Yeah, that's a good call, Jason, because in most cases, dealing with them, they'll want either a board seats. So with the control aspect of it, that's a good call on it.
Yep.
Definitely. Actually had an investor like that recently that wants to call the shots because they're bringing the big check. So definitely.
But thank you for that.
Yeah. Cool. So all right. So another question came in. This is from Facebook with Monique. Thank you. For high earners, would a key principle be a step up from limited partner to maximize investing passively? Okay, I know it's more risk, but would seem to be more reward. From my understanding, KPs can be pretty passive. You want to take that question on, Tim?
Okay. So your KP is going to be your loan guarantor. So you're actually going to be on the general partnership side. So you have to be actively involved. That's actually one of the SEC regulations. You can't be a passive key principal. You actually do have to be involved. So if you do have a large net worth and you're able to sign on a large loan, you'll still have to be involved with the general partners and managing the day-to-day. Is there something else you want to add, Jason?
Yeah, I guess what I would say, and maybe I shouldn't say it, but I'll say it anyway. Like, so I know that some of our key principles have been pretty passive, just because I believe from the SEC's view, or even with the bank, their material participation is to sign on the loan and whatever they provide with liquidity, bank statements. And so when you get into what the participation is, I think that it's very fuzzy, right? So if you're doing an agency loan, they may want updated financials every year, right? So we want to see your bank statements, we want to see the company's financials on a yearly basis. And so that may that may, in terms of the SEC, I don't know, I'm not a lawyer, this isn't legal advice, blah, 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 but that may satisfy the material participation. But I would definitely say, if you're thinking about, if you have the option of saying, I want to be a limited partner versus being a key principal, if you could find a great deal that you believe in, and you have the balance sheet and it's non-recourse, right? I think it's something that you may want to pursue, because you can get more participation in the deal for relatively, not that much more work. That's my 2 cents. Cool. So, all right. That's good. We're right here at 10:45. Appreciate everyone who came on today. Tiffany, thank you for sharing those great deals. As soon as we had our first conversation, I was like, yeah, I want to get her on so I can talk to you, understand more about what you're doing, and have you share it with our group here. For people, I know you've also got a pretty impressive group, right? A meetup of your own. Is there anything that you'd like to share or let people know? I know we had a Facebook question that was asking about how they can invest in syndications. Anything that you can share, I'll try to put in the chat with our audience here.
Definitely. We're actually having a meetup later on this evening at 7 p.m. if anyone wants to join. It's actually how to invest in real estate using your retirement plans. So everyone's definitely invited. Feel free to join us. We do meet monthly to go through educationals on different ways to invest, and just kind of keeping everyone abreast on what's going on in multifamily as well. Also, we do plan on going weekly next year. So definitely check us out, crowncapitalcorp.com.
Can you put that in the chat?
Definitely. I'll put my contact in there.
Also, now I think there was a question about how to get to get access, or how to join your group for the meetup tonight.
Absolutely. I'll actually drop the link in the chat here. You just give me one. Let's see.
So for those on Facebook, don't worry, I got you. We're gonna put it over there as well. So let's see. Sweet.
There you go.
Here's for you. So copy all that. Great. Well, thank you, Tiffany. Really appreciate your time today. Thank all of you for hanging in with us, for hearing about joint ventures, syndications, and just really getting a plan of action that you can take forward as you grow your business. With that being said, you all make it a great day. Be the best version of you, because it'll make you the happiest. All right. I'll see y'all here next Tuesday. Take care.
All right. Thanks, Jason.